This is Bix Weir with RoadToRuta.com. What I'd like to do for you today is give you the second half of the presentation I made down in Mexico at the Anarchapulco conference. This was about exchange and market manipulation. The first half of this presentation was all about RUTA. What is RUTA? Root A, the computer-controlled system that rigs our markets every day, where RUTA came from, who invented it. You can find that YouTube video on my YouTube site. But the second part of the presentation is going to be about computers, derivatives, and electronic market manipulation. Anybody invested in the markets today should know that there is no more freely traded market. A freely traded market has been gone since the 1970s. Now you have a computer-generated and traded market using computers and derivatives, and I'm going to show you exactly how that works. Now, the first part of the presentation was all about the where this computer manipulation came from. And if it's true that the U.S. government, the U.S. Federal Reserve, and their banking prime dealers rigged the markets with computers, then where is the evidence of manipulation? Let's talk about the evidence of market manipulation. And here's the proof and the problem. There's massive electronic trading volumes that dwarf the underlying assets being traded and prove that all electronic assets operate on a fractional reserve system. You can tell by the volumes traded in every single market, from the Dow to the S&P to the gold markets, the silver markets. All of them trade in massive volumes compared to the underlying asset. For stocks and bonds, it's easy to see. Within 5 to 10 days, the total float of a company, all their shares that are issued are traded within 5 to 10 days. Crazy amount of rehypothecation going on. It includes stocks, bonds, commodities, currencies, retirement accounts, brokerage-backed derivatives in every electronic market. This has to do with every electronic financial asset. There's massive asset rehypothecation. Bart Chilton called it Ponzimodium. Every single market has this problem. Huge, massive Ponzi scheme because it's unlimited the amount of trades you can put on. You don't even have to own the asset. You can go long, go short, buy derivatives on it. It's insane what is going on right now. Which ends up with multiple owners for all asset classes. So if you buy a stock through your brokerage house, Schwab or Fidelity or whoever you use, many people own that exact same share of stock that you think that you purchased, and you think your brokerage house went and bought it in your name and put it into your name. They did not. It's put into a pool along with everybody else, and your name is not on that stock at all. It is the largest Ponzi scheme in history. The DTCC is the one who holds title to almost all electronic assets. And they put it all in the name of a fictitious company called Seed and Company. Back in the 1970s, there was a congressional investigation where they were trying to find out who owns Seed and Company. Pretty important, don't you think, if every single electronic asset is put into that name? And there is actually an individual owner. They have not said who it is. A lot of people think it's the Rothschild family or other entities that are not allowed to be spoken of. So it is the big secret. And the key here is to understand that when you buy an electronic asset, you do not own it. And you do not, your claim of ownership is about 3 parties deep, meaning that your brokerage house has to stay in business. Their trustee has to stay in business. The DTCC has to stay in business before you can ever track down where that asset is currently residing. And even Bitcoin exchanges and online wallets participate in the fractional reserve system. We saw that with the closing down or the halting of the 3 largest Bitcoin exchanges in the world in China. These exchanges were trading up to 65 million Bitcoin per week at the end of 2016, which is an insane number. And the Chinese government came in and said, hey, you got to stop this insane amount of rehypothecation going on. So it covers every single asset class, including, of course, the most rigged, the most important asset for the U.S. government to hold down, which is silver. And it is the most abused of all the asset classes. And I'll just go into a little bit about silver and why it is so abused. So physical silver has a very long history as money. It's known as the people's money. It's been money for over 5,000 years. It is also congruent with the use as money. It is also the number one conductor of electricity, number one thermal conductor, and number one in reflective capacity of all the metals. It is an extremely important industrial metal. And in history, we're looking at about 60 billion ounces has been mined, pulled out of the ground, and is above ground in some form. Remember that number, 60 billion ounces in history. Of that 60 billion ounces, 54 billion ounces have been consumed in electronics, industrial, photography, medicine, military applications. Consumed not meaning it goes away. Consumed meaning it is broken up into such little tiny pieces for the use that it is providing that it is not economical to ever get that silver back, even if you could find, the 100th of an ounce that's in your iPhone in the garbage heaps of the world. It's not economical to pull it out at $17 silver. At $100,000 silver, it might be economical to go track down some of this silver that is in all the landfills, but still very, very difficult to find. And currently there's an estimated 2 billion ounces of silver in investment form. And the total of that is only about $35 billion. Tiny, tiny, tiny investment market compared to everything else in the hundreds of trillions. And the U.S. Geological Society estimates there is only 17 years of in-ground reserves of silver in the world. Now, that number has stayed at 17 years for quite a few years. So, yes, they are finding more silver, and according to the USGS, they find as much silver as is pulled out of the ground every year, about 800 million ounces. Is that number correct? I don't think so, but it's an interesting kind of signpost as to what is left in the ground of silver, a commodity and a metal that we consume, whereas something like gold is not consumed. It's, you pull it out of the ground to bear it in your vault. Okay, so we know that silver is an extremely important metal. It's a very small market. The amount of silver available from investors is about 2 billion ounces, but let's see what goes on the markets. In 2016, the COMEX average daily volume for silver was 80,000 contracts, a huge jump up 41%. Average daily volume, that's every single day on average for 2016, 80,000 contracts, which represents 400 million ounces. And 400 million ounces per day comes out to over 100 billion ounces of electronic silver are traded. Were traded in 2016. But remember, there's only 2 billion ounces of above ground silver in the investment form available. And then you pull out of the ground about 800 to 850 million ounces. Every 2 days, the total volume pulled out of the ground all year is traded. And it basically has no relation to the underlying physical metal. And as a great example, the COMEX warehouses supposedly hold about 30 million ounces in the registered category. That's a registered ratio of 3,333 to 1 compared to the amount of silver traded every year on the COMEX. So insane amounts of electronic silver traded vis-a-vis the amount of physical in that market. And that's just one market. The LBMA annual gross transfers volume is over 128 billion ounces, even more. And that's the insane thing about the LBMA, which is now falling apart, if you might have heard in the news lately, because it's supposed to be a physical market. And they're claiming when there's only about 2 billion ounces of investable silver available, They're claiming to transfer over 128 billion ounces every single year. That's ridiculous. Trading on other silver exchanges and over-the-counter private exchanges, I'm estimating about 50 billion ounces for those markets. Silver ETF annual volume, about 4 billion shares. It's about 2 billion ounces is just SLV, and then there's other silver ETFs. And then other types of silver investments, there's estimated to be about 40 billion in the silver pools, silver streaming, silver storage, warehouse silver, leasing, swapping. All are derivatives of the real thing. So what is the total silver derivative traded? About 300 billion ounces of silver derivatives are traded versus 2 billion ounces of silver, physical silver available. Insane amount of electronic blips traded to control the price of silver. And that's a ratio of 150 to 1. If you talk about every single physical ounce that is available for in investment form is traded 150 times. Insane amount of silver derivatives out there. An interesting CPM group, Jeffrey Christian, my best friend. No, he's not my best friend. He's my arch enemy. Or he was. I don't even listen to his work anymore. Anyway, a few years ago at the Silver Summit, he put out this report to justify the silver comics short position. He said there's a tremendous amount of reasons why people would short silver, and he gave a list of all the estimated long physical positions at the banks. And he says that the banks own about 3 billion ounces of physical silver. I think it's completely wrong, flat out wrong. That number is ridiculous. As a matter of fact, the Silver Institute came out with their number, and it's quite a bit off of what Jeffrey came out with. But the key there is that into that report, the short position on the comics, he says, is only 50 million ounces. That is an end-of-day commitment from the Commitment of Traders report. That is not the amount that is traded every day. That's the key. The amount traded every day is where the price is set, not where it is at the end of the day. You could have a 50 million ounce commercial short position, but it trades at 100 billion ounces during the day to set the price. And they trade back and forth to each other. And that's where the big thing that he's missing of this 3 billion ounces. He's saying that it's only 50 million ounce short at the commercial bank's position, which is not true. They trade 100 billion ounces a year, not 50 million. So I'm not a fan of Jeff Christian, never have been, like to make fun of him. A big debate in the silver group has been, does Jeffrey Christian have a comb over or a toupee? We're not quite sure. I had him in the elevator once, was discussing things with him. I was about to grab it, but I didn't. So there's Jeff. Hi, Jeff. Been a long time. Moving on. Now let's talk about rigging with computers and derivatives. I've already showed you where the computer programs came from. Alan Greenspan in the early 1960s invented the computer programs. That's what Root A is. Root A came from the Federal Reserve Bank of Boston. Stephen DeVoe, the computer programmer that worked with Greenspan, implemented these programs to rig the markets and to set the price of all commodities and all exchanges and all electronic financial assets. Alan Greenspan invented the electronic financial asset. He blames himself for the Y2K problem because he only programmed it in 2 digits instead of 4. Anyway, go to that first YouTube video to get the first half of this discussion. But let's talk about rigging with computers and derivatives. You've heard about it in the news. High-frequency trading, they make settlements impossible. Settlements meaning the DTC takes, you settle the contract, you exchange money, you sign over the paperwork, you put the asset in someone else's name. These high-frequency traders trade in milliseconds by the millions. So no, none of these shares are ever settled. As a matter of fact, the DTCC and the SEC say over 300 million shares are not traded. Failure to delivers. And in terms of market manipulation, are front running, spoofing, stuffing, layering, flashing, dark pool liquidity, all this stuff. And they have to invent terms because it's all new to the markets and you're not supposed to know about it. And the DTCC oversees all of it. Is it even possible? There's no contract execution, no transfer of money, no change of title and ownership, but that's their job. Is they're required to oversee all of it. They were the ones in charge of the vault at 55 Water Street that got flooded in Hurricane Sandy. $35 trillion worth of documents were underwater for a week, and then they emptied the water and then they set it on fire. Completely criminal, that institution. And again, the daily transactions are not really tabulated anymore. They're netted. So you buy a share from your brokerage house. They don't go out and buy your stock for you. They net it out at the end of the day because there's so many trades going back and forth. And then even those can't be calculated. Again, 300 million stock transactions are not settled every single day. Failure to deliver FTDs. Average turnover ratio, the TRO of the S&P stock float, is 15 to 20 days. Criminal. It is absolutely criminal that they are playing with stocks in your portfolio, in your retirement portfolio, that you haven't traded in years. They have. How's that? And it's not just a silver problem. That is the key. It's all markets that trade electronically, including the gold market, the stock market, the bond market, brokerage houses, retirement accounts, and even Bitcoin. Our favorite Bitcoin is rigged. Dun, dun, dun. Or shall I say it was rigged. Here's the trading volume for that 65 million Bitcoin that traded in 1 week in January of 2017. Insane. Those three colors represent the Chinese exchanges. This is a 6-month chart for the amount of volume traded on a weekly basis. The three largest exchanges are OKCoin, Huobi, and BTC China. As you can tell, when the Chinese government came out and said, all right, you got to clean it up, the three Bitcoin exchanges put all Bitcoin withdrawals on hold. Customers could still withdraw cash, but they could not withdraw Bitcoin. Very interesting. What does that tell you? They didn't have the Bitcoin anyway. It was all phantom trades going back and forth. Remember, exchanges and online wallets are not Bitcoin transactions that are recorded on the blockchain. Those are purely within the exchange or within the wallet. It's not until you take it out of the exchange and out of the wallets that Bitcoin is actually yours. So make sure if you buy Bitcoin, take it out of the exchange or out of the online wallet after you get it, because otherwise you have a third party sitting there pretending to hold it for you. And you can see the volumes just fell to nothing as far as trading volumes when the Chinese government came in. Great move by China to legitimize Bitcoin. I'm really excited about that. They do have huge plans for Bitcoin. And then we have our favorite case study in silver price manipulation, which is the May 1st, 2011 silver drive-by shooting, also known as JP Morgan's Operation Silver Slam. Take a look at this. We all remember it. If you were in silver back in 2011, silver was just about to bust past the $50 all-time high, right when gold was passing by its all-time high, and it got slaughtered brutally Sunday, May 1st at 10 p.m. at night, when all markets were closed except thinly traded electronic Globex market. Thousands of silver futures and options contracts are dumped into the market to start the avalanche. Over the next 24 hours, over 1 billion ounces of electronic silver futures and options trade hands, and the price goes down 20% and a further 30% for the rest of the week. Silver investor sentiment is destroyed, and fortunes are lost due to this blatant silver price manipulation. And here's how it happened, and why it happened, and who did it. So that's the full chart for the year. As you can see, it started out in January on almost a 45-degree angle straight up from About $25 an ounce to $50 an ounce. Silver people were getting all excited. All the weak hands got in. Note, in 2007, Blythe Masters, the Wicked Witch herself, a credit default swap expert, so to speak. Many people blame her for the crash in 2008 of the credit default swaps. She was moved from the credit default swap area and put in charge of JP Morgan Commodities Division, because commodities is all about derivatives. In March 2008, JP Morgan takes on the Bear Stearns silver short position. That's what really killed Bear Stearns, is their gigantic short position in silver. Then, in January 2011, Jamie Dimon's SWAT team leader, that is Jamie Dimon's name for him, not mine, SWAT team leader Bill Daley is appointed Obama's chief of staff. You have the SWAT team leader at JP Morgan Chase appointed as Obama's chief of staff in January of 2011. I'd send out an email to all my subscribers saying, look out, something's on the way. From January to April, silver price runs up via computer programs to a near all-time high to sucker in long, weak hands into investing in silver. Yes, the price of silver was forced up via computers. This was not a natural move. It was easier because it's the natural inclination for silver to go up when it's not suppressed, but it was completely controlled with computers. It was planned out before Bill Daley got into Obama's White House staff. I mean, that's the president's right-hand man, is the chief of staff. Crazy, crazy stuff. COMEX volume in May 2011 reached 14.4 billion ounces. Remember, there's only 2 billion ounces of investable silver out there. Somehow, 14.4 billion ounces slammed the price down of silver. And there was no CFTC investigation into the operation as it was conducted out of the White House. They're not gonna run an investigation into themselves. It's just not gonna happen. And then we have, here's what happened in what it did. It created an artificially induced bear market for the past 5 years. Unbelievable what has gone on. And it is all artificial via computers. And here's where we sat now. We're at, silver's at 17 bucks. And Trump got in, and they really don't know what to do, so they had to hire Steve Mnuchin, the computer market rigger from Goldman Sachs, to control the markets. And the key is now that they want free markets back, supposedly, but the good guys want no winners. They don't want people making money off this transition back to a free market, but it's kind of hard to do because removing silver price suppression would skyrocket the price of silver, instantly transferring billions to a small population of physical metal holders. Before removal of rigging, they want as few people in gold and silver as possible. Too big to fail silver shorts like Citibank would be destroyed, causing an uncontrollable global monetary meltdown. Counterparty risk and force majeure in all markets. It's a big, big deal. Current operation, irregular market behavior is destroying large physical market riggers like Glencore and Trafigura with trillions in metal derivatives. Yes, those are the two big market riggers started by Mark Rich. Those of you who have followed my work, go to roadtoruta.com, do a search for Mark Rich. You will find out a treasure trove of information about physical market rigging, how to do it, and who is doing it. But eventually the derivative bubble will pop, triggering counterparty failures. That's the moment we're waiting for. The hundreds and hundreds of trillions, if not quadrillions, in derivatives going bad. The global financial system will be frozen, shutting down all markets, banks, and destroying all paper assets reliant on the underlying credit. There will be no bailouts. There's no way Steve Mnuchin can go to Congress now and say, I need $20 trillion to bail out the banks again. The people will not stand for it, and that is the way it has been set up. It is set up to happen just this way. This creative destruction event will be large enough to take down the current system, and those that control it will be removed. Then, finally, after all that, we'll be able to restart the global monetary system and implement free market capitalism for once. I don't think we've ever had free market capitalism at least not in our modern day markets, not since the invention of computers in the 1960s. There has not been one single day of free market trading, especially in silver and gold. And because I was doing this presentation in Mexico, I just had to point out for all those Mexican citizens in the audience, insane what Mexico does with their silver. In 2016, they produced 180 million ounces of silver. 70% of it they exported. They're giving it away to the bankers mainly and to criminals who use it to rig the markets. Since 1900, Mexico has exported over 20 billion ounces of silver. Mexico could be and should be the richest country in the world with their silver holdings, except they've given it all away. Insane. Where is Pancho Villa when they need him? Look up the story of Pancho Villa. He was a great Mexican patriot, and he very much knew what was going on with silver. Do a little research into that. I'll do another video on him and sing one of my favorite songs in that video coming up. Anyway, after all this, how high can the silver price go when it's set free? Well, let's take a look at some of the historical ratios that we're going to be looking at. The Coinage Act of 1792 put silver-gold ratio at 15 to 1, very much like what was above ground and below ground at the time. The in-ground ratio right now is about 12 to 1. So, yeah, silver has a long way to go up in relation to gold. Annual mine production is 10 to 1. For every 10 ounces of silver that's pulled out of the ground, only 1 ounce of gold. So it's like, that is an amazing statistic. But here's the bigger one. If we're talking about the end of manipulation, what is the above ground supply of gold and silver going to be worth? And there's about 6 billion ounces of each. That's a 1-to-1 ratio, silver to gold. And how about monetary metal above ground? Remember, a lot of that silver is not used as money. So say 2 billion of investable silver versus the 6 billion of gold. That's a 1-to-3 ratio in silver's favor. U.S. mint sales versus silver versus gold, they're at 1-to-1 in dollar value. That's a lot of eagles and a lot of kind of telltale sign that there's something more going on with the price of silver. Because due to massive price manipulation on the electronic exchanges, the current silver to gold ratio is 70 to 1. 70 ounces of silver to 1 ounce of gold. That is going to change drastically the very moment manipulation ends. I believe it will cross that 1-to-1 ratio, at least for some amount of time, and maybe forever, because there are so many more uses for silver in industrial applications than there is for gold. Gold's pretty much only a monetary metal. Silver is everything, and the more technology changes and the more inventions that are made, you're going to see more and more money going in to get their hands on physical silver. So that's my presentation. That was part 2, the road to Anarchapulco. Make sure you join my YouTube channel and go to the site roadtoruta.com. Put your email in there and you'll get a free PDF book called Silver, Gold, Bitcoin, and God. And join the Road to Ruta and follow me on all these social network sites. This is Bix Weir, roadtoruta.com. Take care.